Sit here, be a president. A couple issues with that. Will shareholders tolerate that, given maybe they thought they were getting a clean break? Like, you're back to now sleeping on your couch in the office, and that's where we need you to be.
Right.
And what the impact of still being involved could be as he tries to rehabilitate his image of sorts with prospective Tesla buyers.
I think there are a core group of Tesla investors. They're going to buy it. They will, as Elon goes, they go. And when you bring this up with hardcore Tesla investors, Scott, and you know this, we both know some of these people who have held the stock for a long time, and you bring up potential negatives, they all say the same thing. It's Elon being Elon. And if he's not going to be at the Gigafactory in Austin all the time, that's fine. He's driving this company forward. So I'm not sure him going back to Washington occasionally, I'm not sure how much that will further weigh on Tesla's stock. I think we're in a period here where it's going to be a question of deliveries, earnings in the second quarter, and then what do we see in terms of the growth of autonomous vehicle services and subscription revenue? That's what people are going to be watching.
I get it, but it's not like, I mean, the stock's still 30% off of its highs. It's not like people weren't selling the name on the prospect of damaged and impaired sales for a long time.
No, you're right about that, and there always will be. Look, we're going to see pretty brutal numbers in terms of deliveries for the entire quarter in Europe. Now, they don't break them out, but you can do the math. You can figure out what was U.S., what was China. Ta-da, this is what we get in Europe. And the numbers are not going to be good. And there will be some investors who will sit there and say, I don't like the trend when it comes to deliveries. But you're also going to have that hardcore, Scott, who sit there and say, it's not about deliveries. It's about robotaxi and the potential for revenue growth that is going to be astounding in the future. That's if you buy into it. And that's what you're going to have.
Yeah. Phil, thanks. Appreciate that. Phil LeBeau. Up next, Morgan Stanley's Chris Toomey standing by. We'll find out where he sees opportunity for his high net worth clients this summer in the stock market. He'll join us right here, post 9, after the break. We are back. A big question for investors on this final trading day of the month. Can stocks carry May's momentum into the summer? Let's ask Chris Toomey. He's Morgan Stanley Managing Director of Private Wealth Management. Welcome back. How would you answer that? We have a lot of momentum, obviously. Does it last?
I think we're probably still range bound. I think the concern we've got is that while I think we've taken the worst case scenario with regards to the Liberation Day, we're in a situation where I think the market's right now probably pricing in the best case scenario, right? I think everyone's talking about the fact that there's probably going to be 10% tariffs across the board, 30% for China. I think that's kind of baked in. If you look at what's happened, earnings expectations down about 5% this year, down about 10% next year. We still don't have any clarity with regards to what this is going to mean going forward. So you don't necessarily have guidance for companies to make decisions as to what they're going to do in regards to this.
Yeah, but you need that? I mean, if I told you, here, let me pick this. If I told you, okay, 10% baseline tariffs, but we're going to have tax relief and we're going to have deregulation, which, Jamie Dimon went down the list today of all the things that you need to fix that the regulators just have too much of a hold on. Oh, and by the way, because now the Fed knows what's going on, you're going to have tax cuts too. And earnings were already better than expected. Where's the negative in that?
So look, I think the earnings were better than expected after coming down.
Yeah, they were way better.
And I think they're also expensive now, right? So we're still at 22. Expectations have come down. So from a pricing standpoint, the market's still expensive. If you look at the Mag 7, they're still now north of 40% or 40 PE, right? So in our minds, the market's not really pricing in some of these risks that we still haven't worked out, right? And so for our mind, until you get some of that clarity, I think we'll be range bound. I think the good news is we've taken the worst case scenario out of this. I think until we resolve some of these trade disputes, until we actually pass through this triple B bill, until we get some real certainty within the bond market, we would still be a little bit cautious with regards to public.
The market's not going to wait until the bill is signed, sealed, and delivered.
Well, I think
doesn't the market anticipate stuff like this? And probably already has to some degree, wouldn't you say?
Well, look, I think that's the point is I think their positioning is probably too positive. In our minds, we still think if you look at GDP growth next year or this coming year, it's coming down. I think prices are going to go up. I think the Fed, as we heard yesterday, is still on hold. So what we've done is we've taken our earnings expectations down. We've modeled in the fact that the Fed is going to continue to be dovish this year. And our expectation is maybe second half, once we get through some of these things during the summer, we start looking into 2026. And to your point, some of these other things that we're seeing start becoming more prevalent, right? So we're in a situation where we start to see deregulation coming in, which should be beneficial for financials, which we're starting to add to. We also think once the bill is passed, we'll get some real confirmation that we're going to be investing into the U.S., that'll spur economic growth. So we're adding to some cyclicals a little bit in industrials and in energy, but we still think the market's probably expensive right now, and we don't want you to get too aggressive right now from a positioning standpoint.
Part of your answer just now, you said prices are going to go up. What prices? What are you talking about? Like consumer prices?
Well, prices with regards to stocks or prices with regards...
I don't know. You answered the question, and you were listing all the things that were going to happen. And one of the things you said were prices were going to go up. You're talking about companies raising their prices?
So there is going to be inflation, right? So you've got demand coming down, you've got prices going up because, their tariffs are going to go from 3% to 10%. So that needs to be built into earnings, right? So whether or not companies are going to feel that pain, whether corporations are going to feel that pain, whether consumers or governments are going to feel it, it's going to draw growth down, right? The good news is...
That's deflationary, isn't it?
No, that's inflationary. So prices are going down. Demand is coming down.
Demand comes down. It's deflationary.
It's stagflationary, right? So prices are going to stay high or go higher, right? Because costs are going higher. You've got a situation where the global supply chain, where a lot of it is on demand with regards to coming out of China, that's at 30%. We still haven't resolved that, right? And so you can see that with companies that have direct connectivity to China actually not doing as well. You can see that in the Mag 7, and you can see that in the rest of the overall S&P 500. So in our minds, that's going to be a stagflation issue. If we do see GDP growth coming down, that might give us the opportunity for the Fed to step in next year and start cutting rates, and that we think would be
next year.
Yes.
So you don't think they're going to do anything this year?
No, we don't think they move on the data until looking at something in September or October, and then that would probably foresee something happening in next year.
But what if they have more clarity on the tariffs? Like if they already think that they're on the margin maybe too restrictive, if you listen to what Waller said and some of the others who have made comments, if you clear up some of the uncertainty around the tariffs and the trade war, what precludes them from cutting rates later this year?
Well, I think
without an economic calamity to have to act.
Because we haven't really seen the full effect with regards to the inflation that's going to be created because of these tariffs, right? We've still kind of delayed out these different negotiations with regards to trade tariffs. We're in a situation where companies front run their inventory in anticipation with regards to what was going to happen. And I think some of that is not necessarily flowing through the inflation data yet and not necessarily flowing through earnings yet. So I think it's just delayed.
Hasn't the front running already happened?
It has,
on
but the data hasn't.
Corporate fronts?
It hasn't flowed through yet until this data comes in next quarter, and I think that's why I think you're going to see the Fed looking at data more specifically in September and October than now.
Are you worried at all about what Diamond said today about a crack in the bond market?
100%. I think that's the biggest risk to the market. I think 10-year at 450 weighs on the market. 10-year at 5% becomes a real big problem. So I think focusing in specifically on why is he saying this, I think he's looking at that bill and he's saying these deficits are going to be a problem, whether they're today, 6 months from now, 6 years from now. That's the biggest concern. I think he's telegraphing to Washington, hey, we are concerned about this, and the bond market's going to be concerned about that. And if something happens in the bond market, it's going to directly impact the equity market.
Well, there's no question about that. It's the question of the likelihood that something gets messy again. That, as I said earlier with one of our guests, that it was an appetizer in the previous forum in the bond market that rattled everybody, including the White House, and it becomes something more serious this time.
Right, and I think that's why you saw the administration pull back,
no doubt,
after Liberation Day because of what was happening in the bond market. The concern is what's going to happen when these deficits continue to add up. We saw a weak bond auction about 2 weeks ago in the U.S. We saw a weak bond auction in Japan. There's people talking about the CDS market. Obviously, there's issues with regards to reading too much into that. But if we continue to get noise in the bond market, that's going to put pressure on the equity market. And so in my mind, going into the summer with all of these things holding out, you don't necessarily want to be aggressively adding exposure to the equity market. I wouldn't necessarily be taking money from the market, but I would be maybe writing calls on these names that you really like, because I think we're probably in a range bound for the next couple of months.
All right. It's good to have you. It's great to get your perspective, especially as we start the show with a strategist who has a target of 7,007 and get a little more cautious perspective from you, which is, I'm sure, why you make the big bucks and why your clients like you so very much. Chris Toomey, thank you so much.
Thank you.
All right. Up next, we track the biggest movers as we head into the close. Christina Partsenevelos, triple duty for us, I think, at least, unless I lost count.
Yeah, just like yesterday and the day before. But let's talk about one enterprise software firm plunging. I'm smiling, but I shouldn't smile. 12% on slowing growth, while a chip maker is also down 6%, despite CEO reassurances about a major cloud partnership. What's driving these tech names right after this break. Now I can smile.
Buzz.com.
Welcome back. We're less than 15 from the closing bell. Back to Christina now for a look at the key stocks that she's watching. Please tell us.
It's not good news. Elastic shares plunging 12% after the enterprise search software company posted earnings that showed their growth is hitting the brakes. Cantor Fitzgerald, RBC, just two examples lowering their price targets, citing weaker cloud revenue projections. And that's spooking investors who were hoping for more momentum in the AI search space. Shares, like I said, down 12%. Marvell CEO Matt Murphy tried his best yesterday to calm investors' fears about the company's custom chip business with AWS, that's part of Amazon. But the market clearly isn't convinced. Shares are dropping 6% as concerns persist that Marvell is losing significant custom chip content in AWS's next-generation Trainium 3 processors. Their custom AI chip event, though, I want to point out, is June 17th, so that could, strum up some excitement in this name. But shares are down about 6%. Scott?
All right. Thank you very much, Christina Partsinevelos. Still ahead, Bitcoin wrapping up a big month of its own. What's driving that move and what could be next for the crypto space in general? We'll tell you when the bell comes right back. Coming up next, with Wall Street analysts getting even more bullish on Netflix, we'll tell you why, the details, and what could be next for that stock inside the market zone.
tradingview.com today.
We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, a big month for Bitcoin. Today, McKeel is going to tell us why, and Julia Borston on why analysts are getting even more bullish on Netflix. That seems like it's never going to stop. All right, Michael, May is going to be in the books. I'll get you in a minute. Start with Bitcoin. I knew I was going to do that. Tanea, tell us about the run in Bitcoin.
Yeah, Scott, on track for an 11% gain this month, and the driving force has really been this adoption story at institutions and public companies. About $5.5 billion in inflows into Bitcoin ETFs in May. That uptrend is expected to continue and support Bitcoin price through June. You saw this week the Trump media deal to buy $2.5 billion in Bitcoin, alongside other companies deploying similar strategies. So investors are going to be tracking those purchases. Despite market sensitivity to Trump's statements about tariffs or whatnot, White House support for crypto should allow Bitcoin to keep this uptrend in the month ahead. Vice President J.D. Vance was at the Bitcoin conference this week, reiterating that and trying to inspire some confidence about the future of stablecoins. That said, Congress is the bigger question mark. Some positive developments on stablecoin legislation this month, but what happens next in June as the Genius Bill goes to the Senate floor will have a big impact on sentiment around Bitcoin, Scott.
All right, Tanea, thank you very much. Dan McKeel. Julia, tell us more about Netflix today.
Well, Bank of America raising its price target to $1,490. It's more than $300 hike for that target price, saying it's well positioned given the company's unmatched scale in streaming, further runway for subscriber growth, significant opportunities in advertising and sports and live, and continued earnings and free cash flow growth. Evercore ISI also raising its price target by $200 to $1,350, saying increased adoption and attraction of live events is evidence of what they call bundle power. And as Netflix adds to its content, its ability to raise prices will increase as well. Noting that Netflix's ad-supporting offering continues to demonstrate market expansion potential as well as anti-churn leverage. And both Bank of America and Evercore reiterating their outperform ratings on the stock. And in fact, 70% of analysts have a buy rating on Netflix despite that stock's huge run. Back over to you, Scott.
All right, Julia, thank you. Julia Borson. All right, now, Michael, your first word, in fact, is your last word today. I faked you out.
Yeah.
Give us something to think about, the way you're looking at the market and what we learned this week.
Well, this week, actually, the main thing is we sort of preserved the gains of the first half of this month and actually all the way from the lows. You're actually going to end up on the week. We're digesting for 2 weeks what was going on before. Within the range, it's hard to say that the market is really reflecting all that much in the way of new information. We get a little bit of a wobble every time it feels like, the trade frictions might be re-escalating and then vice versa. I think you could take some comfort in the fact that, again, it's another week where the hard economic data held in there, so there was no reason to panic. I'll note for sure, though, that it was a little more of a narrow rally in this last little bit. You said Mag 7 come back pretty hard. And even within that, today NVIDIA backing off and pretty much giving up the post-earnings bounce. We remain in this range I keep showing that is encompassed and reflects the single-day move on November 6th, which is really a wait-and-see market with a wait-and-see Fed as everybody waits and sees whether the hard data in the economy is going to hang in there or not. So all that being, kind of hanging over the market, I think you have to say it was a pretty benign showing this week.
I mean, it feels like we have some good momentum despite, certain price action this week. The question, I know you've been looking at it lately, too, as to whether we can carry it into the summer.
That is the big question. I mean, I think right now it looks like everything is fine. You're working off what was a pretty overstretched position that the market got into a week ago Monday, and you're doing it in a way that's really not causing too much damage. I still think you have, let's call it 4% downside from here, where you'd still say, hey, this is kind of routine stuff, and it looks like we maybe can look to July for some resolution, although we might have to push that out given the recent trade headlines.
All right, good weekend to you, Mike. Good weekend to everybody. We clocked the best month in a long time, a couple years, in fact. I'll send it into overtime. Morgan and John.
that bell marks the end of regulation. Tech NYC ringing the closing bell at the New York Stock Exchange. Bridge 2 Technologies doing the honors at the NASDAQ, and it was a mixed day on Wall Street, with the Dow leading after falling more than 300 points in earlier trading on escalating China trade tensions. Retail in focus again. Shares of Ulta soaring on an earnings beat. Costco also rallying on strong sales. Then on the flip side, Gap sinking on tariff concerns. While the chip stocks lagged today on reports the U.S. might be planning wider China tech sanctions. NVIDIA giving up all its earnings gains, down more than 3%. Lam Research, Intel, ARM lagging too. Tesla was in the spotlight as Elon Musk steps away from his formal role as a special government employee. The stock ending the day lower, though. And Zscaler, the NASDAQ leader, hitting a 3-year high after topping earnings estimates. That is the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort with Morgan Brennan, who's live at the Reagan National Economic Forum in California. Morgan, hey, what's ahead?
Hey, John. We have so much ahead. I'm right here in Simi Valley, California. I'm at the Reagan Library. Ahead, we've got a lineup of guests, including Sean McGuire of Sequoia Capital. He's a big investor in Elon Musk's companies, and many others. I'm going to speak with the Home Depot CFO about the consumer, tariffs, spending, and we're going to get the outlook for real estate with Tim Sloan, Fortress Investment Vice Chairman as well. But earlier today, I did speak with JP Morgan CEO and Chairman Jamie Dimon. This was a 30-minute plus discussion. Dimon giving some very candid answers spanning a multitude of topics. But here's what he said about China. He was just there last week.
I would engage with China. You know, I just got back from China last week. They're not scared, folks. This notion they're going to come bow to America, I wouldn't count on that. You know, and when they have a problem, they put 100,000 engineers on it, and you know, they've been preparing for this for years. So, but we should engage.
So those comments come as President Trump says today that China violated the preliminary trade deal. Eamon Javers is joining us from Washington with the latest details. Eamon.
Hey there, Morgan. That's right. You know, the president began the day today with a post on social media in which he blasted China, saying in part that the agreement that he felt that they had come to in Geneva between the U.S. and Chinese sides didn't come together. Here's what he said. The president saying, because of this deal, everything quickly stabilized and China got back to business as usual. Everybody was happy. That's the good news. The bad news is that China, perhaps not surprisingly to some, has totally violated its agreement with us. So much for being Mr. Nice Guy. Now, Jameson Greer, the U.S. trade representative, said on CNBC earlier today that what the administration is upset about with the Chinese specifically is that they did bring their tariff levels down, but they didn't bring some of the non-tariff barriers down that the U.S. had expected that they would do. That's the point of contention here. That's what got the president's ire today. The president said today he is going to, he hopes, speak with Xi Jinping directly at some point. No schedule for that. No word, Morgan, on when that might happen or what they might say. Back over to you.
Yeah, it's interesting, Eamon, because Dimon on stage today basically talking about the fact that there's an opportunity here for the U.S. to build even stronger alliances across the world, use all and any tools at our disposal, and maybe stand up some from an economic standpoint to continue to do that. But there's also this emerging theme here about the very real IP thefts, particularly on the technology side, where China's concerned that is still going on. You had, I believe it was Senator Mike Rounds said something like $600 billion per year in IP theft. And I have to think that that is part of the discussion when we do talk about things like non-tariff trade barriers.
It's absolutely part of the discussion. I've talked to Secretary of State Marco Rubio about that directly. We've covered it over the years here on CNBC. And the question is, from the U.S. side, what leverage does the U.S. have to get the Chinese to agree to knock that behavior off? But also, what leverage does the U.S. have to get the Chinese to the table? You would have to imagine, given the authoritarian political system in China, that Xi Jinping has a higher pain tolerance than Donald Trump does politically for suffering, you know, in his economy domestically. That would seem to give Xi Jinping a little bit more running room here than Trump might have in terms of waiting out this whole trade war. And so the question is, Can Trump get that call with Xi Jinping? And what can he say on that call that will really bring Xi Jinping to the table? Those things are unknowns. I can tell you that the White House feels they're the ones who have the leverage because China has the factories. The factories are built. They're in the ground. They can't be moved. And they need to export stuff somewhere. And they need access to the U.S. market. So that's the leverage that the U.S. side is counting on.
All right. Eamon Javers, thank you. So how should you invest through this uncertainty? Joining us now is Unlimited CEO and CIO Bob Elliott and G Squared Private Wealth CIO Victoria Green. Happy Friday, guys. Bob, so the macro data, inflation, income still looks pretty good. Anybody who panic sold in April is feeling pretty bad at the end of May here. So what do you buy in June?
Well, I think the key question is, what does the forward-looking picture look like? And when the market right now is sort of all in on the run-it-hot trade, and at the same time, when you look at the actual data around tariff collections, that's throwing cold water on the overall economic expansion ahead. We got $40 billion of tariff collections over the course of just May. That's a $500 billion pace, or essentially a 2% of GDP tax hike that's occurring across the economy. If that persists, it could persist for maybe a short time frame, but if that persists for months, which it looks like it may have, given the court uncertainty, given the conflict here with China, and given the capacity of the administration to extend the tariffs even if they lose in court, every month that goes by, that increases the drip, the cold water being poured on the hot economy. And so that backward-looking data still looks good, but on a forward-looking basis, markets priced to be all in on run it hot might be a bit surprised if this tariff conflict continues.
Okay, so Victoria, one way of reading that is the idea that things are a bit toppy here, but we learned this week that the president is not a taco fan, at least when it comes to market lingo. Do you continue buying these policy-driven dips, or eventually does the macro catch up to you in a bad way?
Hey, look, right now it's keep calm and rally on. Like, I'd buy the tariff dips because he even said it himself. It's all a negotiation. All of this is posturing. It's maximum pressure. I mean, he did write a book about this. So he's kind of following his playbook. I agree we could have some headline risk. We could have some knee-jerk moves down. But for now, the playbook remains intact. Buy those dips. You're seeing economic health. I understand the concern on the GDP drag, but the data's not rolling over. Look at PCE this morning. Again, unemployment next week, it's expected to be very benign, 4.2%. We've had great earnings. Now, June can be really choppy, right? We're through the heat of earnings. We got to wait till July for financials to kick us off. Could definitely get jerked around by moves, but I look at that and I say, I would buy this dip. It's been a great playbook the last 60 days, and if it ain't broke, don't worry about trying to fix it.
Okay, so Bob, what do you do then with an asset like gold, which has been a pretty safe place to hide at times?
Yeah, well, I think in this sort of environment, you want to look for assets that are maybe not overpricing a sanguine environment. And so when you look across the world and when we look at how hedge fund managers are positioned today, what they're seeing is things like foreign stocks, high yield credit spreads, high quality small caps, positions like that haven't necessarily rallied nearly as much from the bottom as stocks have and aren't as sensitive to an extrapolation of extremely strong conditions. And buffering that is something like gold, which really benefits in an environment of a risk-off situation or an increasing conflict situation. Long gold positions really pair nicely with some of those other risk-on positions that maybe haven't fully priced in a sanguine environment.
Okay, on the flip side of that, Victoria, is the AI trade, which, looked decent post-NVIDIA earnings, but then NVIDIA sort of wobbled today, again, on these macro headlines. Is that trade still alive and well?
I think it is. Absolutely. We'll see next week with Broadcom, but we saw Dell, we saw NVIDIA, we saw multiple reports this quarter saying that demand is intact. Your Mag 7 are still spending massive amounts on CapEx. You're seeing much more investment in this space, and we're starting to see people have to pick it up and implement it across their companies. Look, it's still in the early innings, and I know that sounds weird because these stocks have run up tremendously, but if you look at who is actually implementing AI and how much work is still to be done across a company by company basis. The investment is there. And IBM reiterated that. They said, look at how much we saved implementing AI. It was like $3.8 billion. And they're going to help and consult companies to say, how do you continue to shift to your hybrid cloud? How are you actually implementing AI? What programs? How do you train? There's a learning curve here that companies are still dealing with, especially the small, the mid-sized companies. That opportunity is massive. And I look at this and I would buy any dip in NVIDIA. That Blackwell product is phenomenal. I know there's some risk a little bit on, hey, could this get restricted? Could we see? But they already took their China medicine. They've already warned what the hit is. They took an $8 billion hit in Q1. I think they can survive it, and they're going to have plenty of people that want to buy their chips if they can't sell to China.
All right. Victoria, Bob, thank you.
Thanks, John.
Well, Elon Musk ending his tenure as a special government employee and getting a big send-off from the president in the Oval Office today. He said he's ready to focus on his many companies. Up next, I'll be joined by Sean McGuire of Sequoia Capital, a frontier tech investor and an investor in a number of Musk's companies, including XAI and SpaceX. We're going to talk about the investing landscape. Overtime's back in 2.